Crude oil prices fell sharply in late August and early September. So does that mean oil is a bargain? Well, the answer is complex. For starters, OPEC Plus has taken 3.6 million barrels per day off of the market over the past 2 years. Secondly, geopolitical tensions remain high. So what explains oil's weakness despite all of these factors that might ordinarily have supported prices? Well, first, vehicles have become much more efficient over time. The average car in model year 2024 will likely be able to drive as much as 24% further on the same amount of fuel as a similar car from model year 2012. Since a car typically lasts about 12 years, this means that each year drivers around the world would need to drive around 2% further than the year before just to keep demand stable. And at least in the United States, drivers aren't driving any further than they were back in 2019. Meanwhile, the other issue is in China. Last year, 35% of new cars sold in China were EVs. This year, that could grow to over 50%. And China's economy is growing much more slowly than in the past. Since 2005, oil prices have often peaked about 1 year after peaks in China's pace of growth. China's growth rate last crested in 2021. Oil prices peaked a year later in 2022. Moreover, China's economy decelerated sharply over the summer, which might deprive oil of a critical source of demand growth going into late 2024 and into next year. Finally, watch out for OPEC Plus decisions later this year, which could potentially boost output.